So in this article, I want to give you a bit of an update on what's happening in the U.S. economy. And first of all, let me say, the economy's been firing on all cylinders. So I don't want to say that the economy's in trouble, but I do want to point to a few early warning signs. The first thing I'm showing you is the Treasury yield curve. The reason this is important is it's our biggest, most accurate predictor of a recession on the horizon. So if you look, we're starting to see an inverted yield curve. We get concerned when it approaches inversion, we get scared when it crosses it, and it's crossed it. So if you look, it's kind of been trending that way for a while, since about November. And the next graph I'm showing you is a more up-to-date, just looking at the last couple of months, going from basically February 1st to present. And you see that that yield curve has basically strengthened when you zoom up in on it. So I'm concerned about that. The next graph I'm showing you is durable goods. You'll note that durable goods orders are down, but it's also down from a high of 4.7. That's really high. So yes, it's fallen, but it's still, there and kind of in a range that doesn't cause me too much concern. Next graph I'm showing you is the Chicago Fed's National Activity Index. This is another good indicator that we're seeing a bit of a slowdown, right? Overall economic activity has been trending down this year. Now I'm showing you the Transportation Index, i.e. how much freight is moving about the United States. You'll see from the graph that it's been declining since December, but it seems to be kind of ticking back up a little bit. In January, we'll see what the next numbers show. Then as to the world economy, I'm not really going to show you a lot of charts and graphs on that. I'm just going to tell you the world economy is not doing well. Germany's numbers are downright anemic. That's a concern because they're a huge manufacturer. China's manufacturing has fallen quite a bit and has hit its lowest level in 3 years. Air freight out of Hong Kong is down about 7%. That's the busiest air freight terminal in the world. And it looks like world trade volumes are down roughly 1.7, 1.8% in November, December. So that causes us some concern. Now, it's not entirely surprising that we're here. The U.S. economy has been firing on all cylinders. There's no doubt about that. We've experienced huge economic growth, but that's also a result of effectively decreased taxes, tax breaks, increased spending, and so, especially on defense and increased borrowing by the United States. In effect, the United States government has put a ton of money into our economy, subsidizing our economy. We think of an economic stimulus as when the government sends us a check. I know it's happened like twice in my lifetime, where I got like a $300 check in the mail from the U.S. government. I almost wanted to frame it. But in reality, the government does something to stimulate the economy when it gives a tax incentive, when it gives tax breaks, or when it increases spending. We've been spending a lot and taxing less. So that fiscal stimulus is starting to come to an end, so it doesn't surprise me that we're seeing some slowdown. How much, I don't know. I just want to tell you there's some warning signs out there. There's been warning signs, and those warning signs are increasing. I don't think it means we're getting ready to hit outright recession. A recession, by the way, is defined as 2 consecutive quarters of economic contraction. But I do think that we'll see, I do think that we're going to see some sustained slowdown. The next thing I want to talk about is a little bit of what's affecting us immediately in the oilfield sector. And the first thing that I found interesting was a note on the parent-child relationship. Now, when I first read the article in the Wall Street Journal about this, I kind of said, oh, that's interesting, and passed it over. But when I went back and really thought about the implications of it, I'm going to tell you it's huge. So basically, Shale oil drillers figured out, or thought they figured out, that they could get a lot of well efficiency and save a lot of money by drilling new wells closer to existing wells. The existing well being the parent, all the wells that spun off that being the child. And they went out there and hyped to Wall Street and everybody else that there was going to be no decrease in efficiency, that they'd get the same production, and that their costs would reduce dramatically. That hasn't happened. In fact, when you look at it, there's a substantial probability that a child well will produce between 15 and 50% less oil, and worse, it's affecting the production from the parent well. And let me run through the quick implications of that. That means that a lot of shale drillers have overestimated the recoverable reserves, which means they're going to have to take write-downs, which means their creditors who had to tighten their credit lending terms in 2016 pursuant to federal government regulations of oil companies are now going to have less assets on which to lend, which means they're going to tighten their credit. They're also going to be more suspect of that shale driller. So the shale drillers are about to get hit really hard. They're potentially going to have to take a huge write down. Their creditors are going to tighten terms, and their drilling costs just went up substantially. So that the importance of this issue cannot be underestimated. It's huge. Now, I would know Chevron says that they don't suffer from that problem because they claim that their artificial intelligence now has gotten so good, and they're, by the way, the only people that allegedly have this, that their computers are telling them where to drill, and it's just fine. So I don't know about that. So shale money is tightening, and the good news, bad news is that both Chevron and Exxon are increasing their spend. Both of them announced increased capital budgets. Wall Street didn't like that, but that's okay. And so, you know, that's good news for us. The flip side is that a lot of smaller producers, mid-sized producers, have cut their capital budgets, and so they seem to be slowing down, but that's nothing unpredicted. Overall, I want to make another point. The pipeline capacity problem in the Permian has appeared to resolve. The next graph I'm showing you is a look at the spot price in Houston and in Cushing versus the West Texas Intermediate price. You may remember that I referenced this in another article about port capacity and pipeline capacity being a real problem in the U.S., and that problem, at least temporarily, based on the spot pricing, has appeared to alleviate out of the Permian, so that's positive news. And finally, I wanted to take a little quick look at the rig count. The U.S. rig count has grew steadily from January of 2018, but it's now declining. When you look at it, you see it peak, and now we see a fairly substantial fall since January. I'm zooming into the next chart, which just shows it from January to present. Obviously, that's something we predicted. We predicted a bit of a slowdown. I've said since December that I expected this year to be off. And you know, we're also seeing some midstream projects being canceled. Magellan Midstream Partners has announced that they're canceling a $450 million investment for a pipeline. Kinder Morgan has exited an $800 million deal for a deepwater terminal. And Schlumberger's North American chief has indicated he expects North American spend to be about 10% off. So we're seeing some slowdown. However, as I discussed in this week's Ties Take, which I encourage you to watch and read, I don't expect that to last long. Thank you for your time. If you liked this video and you enjoyed it, please smash that like button on YouTube. Thank you so much.